Hello, this is Andrew Westhof, a loan officer in Ann Arbor, Michigan. And today I want to talk to you about the misconception that you need 20% down to purchase a home. So a lot of times I have clients that have been told that they need to save up 20%. And they're told this usually for a couple reasons. One, I have had clients that think that they have to have 20% saved to even qualify for a mortgage, which is absolutely not true. But more often I have clients that are told that you need to save up 20% down, and usually they're talking about purchasing a home using a conventional loan to avoid private mortgage insurance or PMI. So first and foremost, just to make sure everyone is aware, you don't need 20% down to put to purchase a home. Here's the minimum down payments for the main four loan programs: 3.5% FHA. Conventional is actually 3% if you're a first-time home buyer, or if you qualify for Fannie Mae's Home Ready program or Freddie Mac's Home Possible program. Those two programs are income restricted programs, meaning if you make too much money, you don't qualify for them. If you don't qualify if you're not a first-time home buyer, meaning you've owned a home in the last 3 years or less, and you make too much money to do Home Ready or Home Possible, conventional is 5%. So it's not like now you need to do 20% down to do a conventional. Nope, it's just 5%. USDA Rural Development, I don't do a lot of these loans because they're not available in my market. You have to, there's certain areas qualify for them, and there's some income limits and other restrictions on those as well. But you can actually do 0% down. And then a VA loan, you can do 0% down as well. So we'll talk about those in a little more detail, but this presentation is mostly about conventional loans and the private mortgage insurance and how that works. So the reason that people are told you got to put 20% down is to avoid that private mortgage insurance, because they're told, yeah, that PMI is terrible. It only helps the lender, which is true. Private mortgage insurance, what it does is it's an insurance policy that us as lenders take out that we make you pay us for, so that if you default on the loan, that insurance company is going to pay us up to 20% of the value of the home, and then we have to cover the other 80%, so that you're basically on an even keel with folks that put 20% or more down. For that reason, though, the interest rate really isn't much different, if at all, when you put less than 20% down on a conventional loan, because you're paying the insurance policy. We're covered up to 20% of the equity from day one. So sometimes there's some programs where the interest rates vary, and lender by lender they vary a little bit, but not much. So don't think that, oh, also I'm going to get a much higher interest rate if I don't put 20% down. That's not true. It's going to be the same or very close to the same. And PMI is short term. Private mortgage insurance is removable after you pay the loan down to 20%. So it's not even something that's going to be on there for the life of the loan for conventional loans. And then it's the way that I like to think about it is it's basically an increase on your effective interest rate. And I'm going to show you the math on that a little bit here in a second. But what I mean by that is if you're paying a little bit extra per month because you have that PMI, what we can really do is just figure out what your interest rate is if you were making that payment without PMI, and how much higher would that make your interest rate would be, or your effective interest rate. So when people tell me, oh, I hear PMI is terrible, it doesn't help me, I don't want it, so I need to save 20%. Well, you know what else is terrible and doesn't help you is interest rate. So you're paying interest on the loan anyway, and that's to the lender. That's not anything that benefits you at all. So really, with that mindset, you need to save up 100% of the home purchase so you can pay cash and avoid having to pay any cost to a lender. So obviously that's not feasible, and a lot of times 20% down isn't very feasible either with current home prices and how homes have appreciated so quickly. So here's what it looks like, and I ran these numbers based on a $250,000 purchase on December 26th of 2021. I'm recording this video on January 4th of 2022, so almost a week later. But just to give you an idea of what the payments would look like with different down payment amounts and different credit scores. So the way that the private mortgage insurance companies figure out how much to charge you a month is the less you put down, the more that they have to insure. So they're going to charge more for the private mortgage insurance with less down, just because the insurance policy is bigger. And then they're also going to charge you more with a lower FICO score, because they figure if you have a lower FICO score, lower credit score, you're more likely to default. So you can see with the 660 credit score, 680 credit score, especially with the lower down payments, that private mortgage insurance can be pretty high. These are usually the credit scores where we seriously consider doing FHA versus conventional, because a lot of times it just might make more financial sense to do so, because the other thing is that is also on conventional loans where you're going to pay a much higher interest rate. I did a FHA versus conventional uh, video as well. So if you want to check my page and are curious about the differences between those two programs, there's some pricing examples in there also. So feel free to check that out. Once you get to 700, that's a little bit of a gray area, but usually conventional makes more sense. And then 720 and above, it's almost always conventional is going to make the most sense. And so if you're just to kind of look at it like with a pretty low down payment, 3%, your private mortgage insurance is $97. So it's not nothing, but it's not terrible either. But even when you get to just 5%, that goes to $77.19 with the lender that I priced this out with. And you can see when you get to 10% and 15% down, those monthly mortgage insurance amounts go down pretty quickly. So to put it in that effective interest rate terms, this is a chart on what that would actually look like if you were to if you were to have a monthly payment with the principal and interest plus the private mortgage insurance. What would that total interest rate be? So if you look at, say, 720 credit score with 5% down, the effective interest rate is an increase of 0.576%. So it's not terrible. Right now, interest rates are in the low to mid threes. So you're still going to have an interest rate in the high threes to low fours if you were doing this today with a 720 credit score. This isn't an offer of credit. This is just to give you guys an idea of what this looks like in real terms. So you're not all of a sudden paying hand over fist because you have private mortgage insurance on your loan. So I want to give you the rates for the other couple loan programs as well. So FHA, the effective rate would be 1.226%, the same $250,000 purchase price, $169.24 a month. USDA has really low monthly mortgage insurance, so it would only be $73.64, and that's with putting 0% down. 0.536% effective interest rate, and then VA is 0% down and 0 monthly mortgage insurance. Now, I should note that on all three of these programs, there is an upfront mortgage insurance premium. FHAs and USDAs you can't get away from. You have to pay it. And then VAs is you're going to pay it unless you have a VA disability. If you have any VA disability, you don't have to pay your upfront VA. It's called a VA funding fee. So 0% effective interest rate increase with VA. So this is how this kind of looks. So to say you're purchasing a home today at $250,000 with 5% down on that 720 credit score. That would be a 3.375% interest rate. Again, not an offer for credit. That's just where, with looking at the lenders that I usually use, that's about where the rate would be today on a conventional loan. So that would give you a principal and interest of $1,049.98. Which would be $77.19 with the PMI, which is the same as what was on that previous chart. So your effective interest rate would be 4.081%. So you're still in the very low fours. And if you were to buy this home today with the interest rate at 3.375, if a year from now the interest rate is 4.125 and you waited to save up 20% down, you're actually going to be a higher effective rate without mortgage insurance. So, and rates move up and down every day, and we do expect them to be increasing in 2020. That's what most of the predictions are saying. So let's say that you needed to wait 3 years if you needed to gain another 15% down to get to 20% total. So you ran the numbers. This is how much you need to wait. 3 years from now, if you had purchased the home with 5% down versus waiting, you'd have paid $13,318.61 in principal, just making your minimum monthly payments. So you've already gained that $13,318 in equity just based on making your minimum payments if the market doesn't move at all and the home is still worth exactly $250,000. But we know that the market typically goes up, and it's gone up significantly the last 10 years. So the 10% was not uncommon for most years. And in 2021, in most markets, they went up 20%, 15, 20, 25%. But that's not really sustainable. On average, home values increase 3% to 5% annually. So if we look at the lower side of that, 3%, the value from just the market, just the home value increasing without considering monthly payments, is an extra $23,181.75. So combined with the $13,318 from payments and $23,181.75 from the appreciation of the home, you get a total of $36,536 of extra equity in the home because you didn't wait. So if it were on the higher side of that 3 to 5% annual, that goes to $52,724.86. So there's definitely a cost to wait there, assuming that if you're waiting to purchase a home and you're saving up that extra 15% down in this scenario, you're paying rent. That rent money's gone out the window. So there's obviously that consideration as well. And what I just mentioned, if the interest rates go up, you might be worse off anyway. So another thing to point out is that with current interest rates, and again, it's January 4th, 2022. So if we're further out, obviously interest rates change every day. But today, the interest rate is such that every $10,000 you borrow is about $45 to $50 per month on the principal and interest payment. The reason that I bring that up is because, one, if you're waiting and the home value is increasing, you're probably borrowing more money, so your payment's going to be higher for waiting. And on the flip side of that, I hear clients go, well, also, yeah, if I put 5% down or 3% down or 10% down or whatever the number is, if I put less down, I'm borrowing more money, so my payment's going to be higher because of that. And sure, that's true. So, but a lot of times it's not as big of an issue as people think. Obviously, run your numbers and make sure it works for your situation. But on $250,000, 5% down is $12,500. If 20% down is $50,000. So $50,000 minus $12,500 is $37,500 more that this borrower would be borrowing because they put 5% down versus 20% down. So if we figure $50 per 10,000, so per 10,000 there's 3.75. 3.75 times 10,000 is that 37,500 times 50 is $187.50. So they're paying $187.50 more today for the higher loan amount. They're not really getting punished for that, though. They are borrowing the additional money, but as long as that fits in their budget, it's not like they're getting a worse rate or they're paying more. The only thing they're really getting punished for is the private mortgage insurance. And then private mortgage insurance is removable with a conventional loan. So when you get to 20% equity based on the purchase price or the appraised value, whichever is lower, you can call your mortgage servicer up and say, hey, I've made all my payments on time. Please remove my private mortgage insurance. As long as the market value has not significantly decreased, they will remove it as long as your payments have been made on time. So if you're paying extra per month, then you can get that private mortgage insurance removed sooner. So if you're in a situation where you're thinking it's going to take you 3 years to save up an extra 15% down, and you kind of run the numbers, and your total monthly payment for the new home is similar to your monthly rent payment, well, you're going to be able to pay down the new mortgage to get the private mortgage insurance removed in about 3 years also. So the time period is about the same, where you're going to be similar on, being able to move that private mortgage insurance, and interest rates are probably going to be lower today than they are 3 years if you're watching this in January of 2022. So certainly something to consider. Again, my whole point of this is not to tell you guys to go ahead and buy a home, put minimal down. If you're out there searching for a home, or you have a time period, a year, 2 years, whatever it is down the road, certainly save as much as you can. The more you put down, the better the monthly payment is going to look for you, and it's going to give you a lot more flexibility while you're out there making offers and things like that, to have more money in the bank. But my point is that if you're looking at your budget and you're going, man, it's going to be a long time before I get to that 20% number, you don't need 20%. It's often a mistake to wait to save up 20% if it's going to put your trajectory on homeownership a ways down, because you're just wasting money on rent, and you're not really benefiting financially. You're actually negatively benefited in most cases. So I hope this is helpful. If you have any questions, please feel free to put them in the comments. I'll put my contact information in the show notes. So if you have any specific questions, feel free to reach out to me. And if you would like the video, and if you want to see similar content, subscribe. That motivates me to make more videos. But I really appreciate it, and hope it was helpful.